Hello traders, James Stanley with StoneX and Forex.com. The US dollar is dropping again on the back of the CPI report from yesterday. And the CPI report didn't look all that weak for US inflation. But more recently, it's been a larger overriding factor that I think has been pushing not only the US dollar, but major currencies across the FX market. That factor is President Trump and wanting to get rate cuts in for the U.S. economy. The question remains, A, is the Fed going to cut? And then B, even if they do cut, what are the reverberations of that going to be? And then for my purpose, how are currencies going to react? I'm going to look at that in this video through a few different venues, a few different areas. So let's get over to the charts. First and foremost, we have the USD at a really big area of support right now. Like if we take this trend line from that originated back in 2001 and connects in 2020. There was a low that confirmed that trend line in 2023 more recently. And we could look at this from like the weekly chart. You could see where it's had a tendency to show support as it did in April and then June. A quick little test of resistance before it came back into support. It's back into support for a test again today. Shorter term, and this is where I think a bit of contrarianism comes into play. We've had a hold of higher lows so far. The dollar was beaten down in the first half of the year, largely on the back of that premise for rate cut hopes, rate cut expectations. The data didn't really cooperate, but with such a strong push towards getting rate cuts in the back half of this year, the dollar just gave it up. We had initial fears of a recession in March. Continued fears of weakness in April. More recently, it's been where we've seen that inflation component stalling out. That's what led to the build of this falling wedge in the dollar. And then more recently, since the Q3 open, the dollar has been holding these higher lows. And that's even with Trump pushing for rate cuts and a weak dollar very, very consistently, very, very aggressively. We had the CPI report back in July. It was right here. That's what led to the dollar's breakout from that formation. And I even said in a webinar at the time, just after that CPI release, it wouldn't surprise me to hear President Trump come out and threaten to fire Jerome Powell because he's getting the exact opposite of what he wants to see right now in the dollar. That happened less than 24 hours later, and that's what gave us this pullback in USD. But once again, the Fed remained non-committal to rate cuts. The core PCE release that was in late July also came out with strength, showing continued inflation in the U.S., and that's what gave this breakout continuation. But it's right here where things began to shift, and that was in the NFP report. That's where I think the very real question of what the Fed's going to do in September begins to populate. When we were at the FOMC rate decision in July, Powell said the Fed was looking at the unemployment rate. The unemployment rate was close to full employment at 4.2%. On NFP Friday, that printed right at the expected. The more jarring factor was the revisions to prior months, and that's what brings in, again, fears similar to what we had in March of weakness in the U.S. economy, maybe even recessionary fears. And that's what's hustled this short-term sell-off, this recent sell-off, and the USD to get down to this longer-term support area, and also the shorter-term support area. But if we look through the data, it's not such a clear case for rate cuts. Markets right now are fully pricing in a cut in September. 99.9% probability per CME Fed Watch right now for a 25 bip cut in September. Go out to the end of the year, 57.6% probability of getting 2 additional rate cuts. So that's expecting the Fed to cut at each meeting into the end of the year. That's a really dovish posture from the Fed. And high expectations for that. But again, if we go back to what Chair Powell said at the FOMC rate decision, it didn't look like a U.S. economy that was in dire need of rate cuts and loosening. We had near full employment. We had inflation still on the rise. And on that topic, we could take a bigger picture look at those CPI statistics. So yesterday, we saw headline CPI come back out at 2.7%. The same as the prior month, and then we had core CPI rise back above 3% to 3.1%. And as you can see here, inflation has been climbing from both headline and core CPI. With core PCE, often called the Fed's preferred inflation gauge, that's printed at 2.8% for the past 2 months. And that's after it dipped down to 2.5%. So that, again, has been going up. Makes for a difficult case for the Fed to justify rate cuts. And then if we look at what happened last year, and let's first look at the dollar and the way this traded last year. So last year, as we went into the Fed's cut, the first cut from the Fed was September 18th of last year. And you look at what happened in the dollar got beaten down as we walked into that rate decision. And it was right here where the dollar started to set that low. It was just right around the actual rate cut. Again, right here. Wednesday, September 18th, we established that low at 100.22. Fed cut 50 bips there. It was a massive cut. But notice it was just a couple weeks later that the dollar started rallying. And even though the Fed cut twice more last year, similar to what markets are expecting this year, September cut and then 2 more, even though the Fed cut twice more, the dollar continued to rally. The reason is because of inflation expectations, which led to rate expectations. Now again, notice that inflection point, September 18th last year. And then the dollar rallied all the way until January 13th of this year when it set the current high. If we look at this from 10-year Treasury notes, again, it was September 18th when the Fed cut rates. The 10-year set a low yield the day before at like 3.6% roughly. January 13th, when the dollar set its current high, the 10-year yield was all the way up at 4.81%. And that's despite the fact that the Fed cut rates 100 basis points in that period of time. Just because the Fed cuts, it doesn't mean that long-term rates are going to go down. It doesn't mean that it's going to be stimulative. It doesn't mean that the dollar is going to fall, as we saw with all of those things happening last year. 10-year yields, massive move, even as the Fed was cutting. We could go to 30-year yields, which are perhaps even more important for the U.S. economy because this is where mortgage rates are based off of. 30-year mortgage rates often have more of a tie to 30-year treasuries than they do short-term overnight rates at the Fed. If we look at where those traded, that same Tuesday before the rate cut, it dipped just below 3.9%. January 13th, those were at 5%. Right there at 5%. Eventually topped at that 5% level. Since, they've gone back up to another fresh high. Right there in that range above 5.1%. So even if we get the cut, it doesn't necessarily mean that long-term rates are going to fall. It doesn't mean that the dollar is going to continue to fall. And what has my attention right now is the fact that the dollar is holding these higher lows even though Trump has been throwing the kitchen sink at the matter. Now, as far as what Trump wants, and this is why I think it's pretty clear, he said it. He said, a strong dollar sounds good, but you make more with a weaker one. And he had this quote. I'll enlarge that. So when we have a strong dollar, one thing happens. It sounds good, but you don't do any tourism. You don't sell tractors. You can't sell trucks. You can't sell anything. It's good for inflation. That's about it. Well, we've had a weak dollar. And that's, I think, one of the reasons that inflation has built. Now, another important aspect to consider here with currencies is currencies are the base of the financial system. So if we're looking at a currency and valuing a currency, the only way to do it is with another currency. It's not like gold or stocks that are essentially a binary decision, up or down. In currencies, especially the dollar is a composite of underlying currencies in a basket. 57.6% of which is the euro, 13.6% of which is the Japanese yen. So that's another reason that longer-term currencies will have a tendency to show perhaps more mean reversion than a singular market like gold or stocks. So if we're looking at the USD to fall, we need to then ask, can other currencies take on that strength? And for me, and the way that I run my strategy, that usually means I try to remain balanced around the dollar. I try to find something that works well in a dollar weakness scenario. I try to find something that works well in a dollar strength scenario because I don't know what's going to happen tomorrow. So, like for instance, right now, if I'm looking for the dollar to break down and run into fresh lower lows, I'm still tracking bullish setups in cable. Cable, the British pound against the US dollar, has been a massive move on the back of this recent gyration around USD. And you can see that coming into play right around that Friday NFP report. And it goes back even to before that. Like, for instance, when we had the early rally in July in the dollar, you can see where sterling is pulling back against USD all the way until this support zone comes into play. And this is a big support zone between 133.95 and 134.14. Really big support zone. This was the same one that held the highs back in Q3 of last year. We had that initial rally in the dollar. Cable pulls back. And again, it was right around that US CPI report that I said, look out, this is where Trump could fire Powell to try to shake some USD weakness into the mix. When Trump levied that threat, cable popped right in here. It was when it pulled back and then held higher low support in there that a short-term rally began to build. Then as USD strength comes back, we saw another sell-off in cable. That was a pretty consistent move all the way until that Friday NFP report. Support shows at 131.45, the same low that it held back in May. Right in there. Also a prior spot of resistance from April, but right there, that's what caught the low. Since then, it has been a revival in the bullish trend. We had the rally with a short-term higher high, then a higher low, and then bulls have just taken this away. If we're looking for the dollar to break down, this is the venue that I still think is attractive. We're back above that 135 level. Bulls have a full head of steam. I think there's a lot to like on the long side of the British pound if we are going to see USD weakness to continue. For USD strength, on the other hand, I'm still of the mind that Euro is an area that I want to be tracking. And the reason for that is it comps well with what we have in the USD setup right now. In USD, we have the dollar selling off, holding those higher lows, and that's really where the question is. Are we going to see bulls defend that higher low, or are we going to see sellers go for the jugular? Well, you see the mirror image of that setup in Eurodollar right now. And there are some big Fibonacci levels that are at play. Like if we go back and we look at the Fibo retracement from the 21 high to the 22 low, the 618 caught the high in 23. The 50 and 38.2 caught this range for a good portion of last year. The 23.6 is what caught the low back in January. You want to see what day that was? January 13th, same day that 10-year yields topped, same day that the dollar topped. Since then, it's been reversion. Now, and ever since the Q3 open, we've had this series of lower lows and lower highs that have posted in. As we've had that USD weakness rushing back after that NFP report, you could see where we're pulling back. But still, that longer-term structure is in play, and the big test is right here at like 117.48. If we break above the swing high here, the lower high at 117.88, that's where it doesn't look so attractive anymore. And then that's where I think British pound breakout strategies, British pound continuation scenarios, I think that's where that looks more attractive. But I think when looking at the dollar, it always deserves some element of balance, because on a longer term basis, I think that currencies have more of a tendency towards mean reversion, towards swing setups than what we might see elsewhere in something like a Bitcoin, a gold, stocks, etc. But that's what I'm looking at from here. And it's going to remain a hot button topic until we get to that rate decision just a little over a month away in September. And right now, markets are fully expecting a 25 bip cut at that point. So that's priced in. The dollar's still holding a higher low, even with all that background for USD weakness. I think it makes for an interesting setup across the currency markets right now. But thank you for your time. And as always, happy trading.